we are going to talk about the equity method. This method is used when a company or an investor owns between 20 and 50% of the common stock of a corporation. So to record the acquisition of a stock investment, the journal entry is as follows. Let's look at the facts here, though, first. Millar Corporation acquires or purchases 30% of the common stock of Beck Company for $120,000 on January 1st, 2014. So we're going to debit stock investments. And I want to make this clear. You do not debit common stock because we're not issuing our common stock, and if we were issuing our common stock, we would be crediting common stock. So there's never an instance where you would debit common stock account. So even though we bought common stock, or if we had bought preferred stock, it wouldn't make any difference. You would debit stock investments. And so we'll debit it for $120,000, and then we will credit cash for $120,000. So we're going to record the revenue and dividends of Beck Company. So let's say for 2014, Beck reports net income of $100,000, and it declares and pays a $40,000 cash dividend. So the way the equity method works, because we own between 20 and 50%, it's presumed that we have significant influence as to how the company is run and influence onto how much net income they make and how many dividends they declare. So because of that, we are going to show our share of that net income as if we had earned it ourselves. So the journal entry to show our share of the net income will be a debit to stock investments. And this is the same account that we used up here when we originally bought it. So basically we're increasing the amount of our equity by, we're going to record our 30% equity. So the calculation for that is you would take 30% times the $100,000 net income. And so we're showing that 30,000 of that it's as if we had received it and turned right around and given it back in and said, I want to reinvest it in the company. And then we're going to credit revenue from stock investments. So we're going to show our $30,000 of that $100,000. Now they paid a $40,000 cash dividend. So to record that, we're going to debit cash for our share of that $40,000. So we own 30% times 40,000. What would have come to us would be 12,000. So we're going to debit 12,000 to cash, and we're going to credit stock investments. So what we're doing here is we are adjusting our investment account for our share of the net income and reducing it for our share of the dividends. So if we were going to do a T account here for our stock investment account, the original debit was $120,000. Then our share of the net income was $30,000. So our investment went up by that amount, but we actually received 12,000 of it in cash, so that reduces our investment. So our ending balance is going to be 138. And that is the balance in this investment account. If I were to sell these investments right now, that would be considered the cost that I would compare to the selling price to see if I had a gain or a loss. So to summarize, in sort of a generic T account, under the equity method, your original purchase price is going to be debited. Then your share of the net income is going to be debited. So I'm just going to put share of net income. And the dividends that you receive are going to be credited. So you will debit or credit dividends you're going to debit stock investment for the amount of dividends received. And that is what your stock investment account is going to look like.